Most people spend years learning about stocks while completely ignoring the bond market. Yet bonds influence almost every financial decision you make, from mortgage rates and savings accounts to business loans, retirement portfolios, and even the stock market itself. In this story-driven video, you'll discover why the bond market is often called the most powerful market in the world. Through simple examples and real-life stories, you'll learn how bonds work, why governments and companies issue them, how interest rates affect your money, and how understanding bonds can make you a smarter investor and business owner. Whether you're buying a home, investing for retirement, or running a business, this is one financial lesson you can't afford to miss. The invisible market that controls everything. Start with the story of Daniel, a hardworking man who thought the stock market controlled the economy. Every day he checked stock prices, watched financial news, and believed that if stocks went up, life was good. Then one morning he tried buying a house. Mortgage rates had suddenly climbed, adding hundreds of dollars to his monthly payment. Confused, he asked why. A banker smiled and said, "You're looking at the wrong market." That single sentence changed everything. Daniel began discovering a world most people never notice, the bond market. It doesn't make exciting headlines, but it quietly controls borrowing costs, home prices, business expansion, savings accounts, government spending, and even stock prices. Imagine the bond market as the foundation of a giant building. Everyone admires the beautiful floors above, but almost nobody thinks about the concrete underneath. Without the foundation, the building collapses. The same is true with money. Before understanding stocks, real estate, or businesses, you first need to understand the market that determines the cost of money itself. What is a bond? Daniel met an old investor named Michael, who explained bonds using a simple story. Imagine lending your friend $1,000 for 5 years. Your friend promises to pay you 5% interest every year and return your $1,000 at the end. That's essentially a bond. Governments borrow this way, companies borrow this way, cities borrow this way, investors become lenders instead of owners. Stocks make you a partial owner of a company, but bonds make you the bank. The reason bonds matter so much is because trillions of dollars move through this market every day. Pension funds, insurance companies, banks, and central banks all depend on it. As Daniel learned more, he realized nearly every dollar flowing through the economy touches the bond market in one way or another. Even the interest paid on a savings account begins with what lenders can earn in bonds. Suddenly, finance became much easier to understand because he finally understood the price of borrowing money. Why bond prices and interest rates move opposite each other. Michael drew two simple arrows on a piece of paper. When bond prices rise, yields fall. When bond prices fall, yields rise. At first Daniel couldn't understand why. Michael explained that if an old bond pays only 3% but new bonds now pay 5%, nobody wants the old one unless its price drops. That's why prices and yields always move in opposite directions. This simple relationship affects mortgages, business loans, auto financing, and credit cards. When investors fear inflation, they demand higher yields. Higher yields make borrowing more expensive for everyone. Businesses delay expansion, families postpone buying homes, and consumers reduce spending. Understanding this relationship explains why markets react so dramatically whenever interest rates change. Daniel finally realized that what looked like complicated economics was really just supply and demand for money itself. How bonds affect everyday life. Daniel began noticing bonds everywhere. His savings account earned more because interest rates had risen. At the same time, his mortgage became more expensive. Small businesses struggled with higher loan payments. Some real estate investors stopped buying properties because financing costs erased their profits. Even the stock market became more volatile because investors compared risky stocks with safer government bonds. If bonds offered attractive returns, many investors shifted money away from stocks. Retirement funds adjusted their portfolios. Governments paid more to borrow, increasing budget pressure. Daniel realized that almost every financial headline could be traced back to changes in the bond market. What once seemed like a boring subject turned into the hidden engine driving the economy. The lesson that changed everything. Years later Daniel became financially confident, not because he predicted stock prices, but because he understood how money flows through the economy. Whenever someone asked about investing, he started with bonds instead of stocks. He explained that understanding the bond market helps people make better decisions about buying homes, refinancing mortgages, expanding businesses, saving for retirement, and managing risk during uncertain times. He learned that successful investors don't chase headlines, they understand the systems behind them. The bond market may not be exciting, but it quietly shapes the opportunities available to everyone. Daniel's greatest lesson was simple: if you understand the price of money, you'll understand almost every major financial decision. And once you understand bonds, the rest of the financial world begins to make sense.